สวัสดีค่ะยินดีต้อนรับสู่การนำเสนอข้อมูลของบริษัท PSL Shipping จำกัดมหาชนนะคะหรือว่า PSL สำหรับผลประกอบการไตรมาส 1 2025 นี้โดยลำดับแรกเนี่ยจะเป็นคุณคาริด ฮาชิมกรรมการผู้จัดการนะคะจะอัปเดตในเรื่องของภาพรวมของอุตสาหกรรมและตามด้วยคุณกอตั้มภูรณากรรมการการเงินในเรื่องของผลประกอบการไตรมาส 1ส่วนท่านใดมีคำถามสามารถพิมพ์เข้ามาในระบบได้เลยนะคะเดี๋ยวเราจะตอบคำถามในช่วงท้ายค่ะช่วงแรกขอเชิญคุณคาริดค่ะ
As usual, we will do the presentation in two parts. I will do the industry section and then Gautam will take you through the finances of the company. So if you look at China, it is about 42% of the total dry bulk imports in the world. And if you look at them, they have done reasonably well in the first quarter, though it was impacted quite badly with the tariffs. So despite all the tariff issues, iron ore was down by just 8%. Coal was down by just under 1%. Steel production was actually up by 1.1%. Steel exports was up by 6.2%. Steel consumption was up by 0.5%. And alumina and bauxite imports in Q1 was up by 30%. So overall, you would say that China has done reasonably well. If you look at the steel consumption by sectors in China and look at the overall position, you could see that in the 8-year, if you compare it with the 8-year average, last year was up by 3.71%. And if you look at the 5-year average, it was just down by 1%. So it seems that China is still consuming a lot of steel. If you look at the steel exports, they have been remarkable. Steel exports rose by 5.8% in March to 10.5 million tons, a 6.2% year-on-year increase. If you look at the steel consumption, it increased marginally. If you look at demand for Chinese steel, it's expected to fall in 2025 because of the new tariffs in place by the US. But as we have seen in the last few days, the tariffs have been lowered from the 125% to just 30% by America. Growth in auto, energy and shipbuilding sectors will offset weaker demand from construction. And if you look at Q1 2025 freight market, it started on a softer note compared to last year. But keep in mind that Q1 is the slowest quarter of the year traditionally. Because of the strong exports of steel from China, all the handy Supras and Ultra ships that we have in our fleet benefited from these steel exports, leading to a strong Pacific market even in Q1 of this year. If you look at the USTR regulations as announced on the 17th of April under Annex 1, they say that the fees imposed will not apply to any US government cargo, neither will they apply for the first 180 days. After 180 days, there will be fees applied to Chinese owners and operators based on net tonnage per US voyage. And this will increase incrementally over the following years. Fees on operators of Chinese-built ships based on net tonnage or containers carried will increase incrementally again over the following years. And to incentivize US-built car carrier vessels, fees on foreign-built car carrier vessels will be based on their capacity and will apply just straight away after the first 180 days. The second phase actions will not take place for 3 years. To incentivize US-built LNG vessels, limited restrictions will be placed on transporting LNG via foreign vessels. These restrictions will increase incrementally over the next 22 years, allowing the US to build US-built LNG ships. If you look at Annex 2, it does not apply to the following Chinese-built ships. Ships that are owned by the US military program or used by the military program, ships that arrive in an empty condition, i.e. in ballast, or ships if they are container carriers with less than 4,000 TEU, if they are tankers then less than 55,000 deadweight, or if it's a bulker, less than 80,000 deadweight, then there is no charge for any of these three categories. Vessels arriving in the continental US from 2,000 nautical miles away or less, again, will not have any fees under the USTR regulations. US-owned vessels, whether the US entity owning the vessel is controlled by US persons and is at least 75% beneficially owned by US persons. And specialized special purpose vessels will not be charged, which carry chemical substances in bulk liquid form. And then, of course, ships that trade in the lakes or laker vessels, as they're called, then they will not be charged also. If you look at this chart, it explains this in a much clearer way. The USTR regulations came on two separate dates. On the first date, they made a proposal on the 21st of February, which said what all they would charge. And if you see the figures in bold and in parentheses, it shows you on the right-hand side of each of these columns, you can see that that is what the proposal was. And it would impact that many percentage of ships. But then on the 17th of April, when the law actually came out, you can see the figures which are on the left-hand side in column 3, column 5, and you can see what is the impact of that. So if you look at it from that point of view, the USTR has watered down their regulations quite significantly. And the amount of ships caught in the USTR law is not very significant as compared to the whole bulk fleet, as can be seen in this chart. So they do not apply, as I've said already. So what is the impact on commercial dry bulk shipping? Provided the ships are bulk cargoes are moved in larger than 80,000 deadweight size Chinese built ships, then you have a problem with Annex 2. Our fleet has got all small ships. Our largest is 63,500 deadweight tons, so it's free from all USTR fees. As a result, there will be a two-tier market. Ships that are under 80,000 deadweight tons and can trade anywhere in the world and do not have Chinese owners or operators will charge a slightly higher fee than normal for American cargoes. The other Chinese owned and operated fleets will work their ships excluding American ports. Disruption caused by trade flows shifting with Chinese owned operated ships carrying cargoes to countries close to the US and then transshipping those goods via non-Chinese owned operated fleets into the US will result in congestion, will remove supply of available ships and will lead to a spike in rates. However, if there is a US recession and it drags the rest of the world into recession, that would be very bad for every business, including dry bulk. Now that the tariffs have been watered down for China, most people are not worried anymore about a US recession or the rest of the world going into a recession. Dry bulk trade and traffic impacts. So China is a massive exporter of containerized goods. But if you look at dry bulk, not so much. China exported 168.4 million metric tons in 2024. That is just 3.1% of total global exports. And all these exports were mainly short haul in East Asia and Southeast Asia. USA accounted for just 1.7% of China's dry bulk exports, or 2.9 million metric tons in 2024. So China has had 8 years in which to learn to live with tariffs, and they have significantly reduced all their dealings and exports to America on the dry bulk side. But when it comes to imports, China is the 800-pound gorilla in the room. If you look at the total imports into China was 2,273.7 million metric tons, or 42.2% of total global dry bulk imports. The next best was European Union at 7.9%, and India was a third at 6.8%. Of this 1,248.8 million metric tons, you can see the breakdown in terms of coal, iron ore, bauxite, etc. All of them you can see over there. And if you look at what did US export, just 2.4% of dry bulk goods to China, or 52.4 million metric tons in 2024. It consisted mainly of grains, soybeans, and other grains, 6.9 million metric tons of steam coal, 4.8 of coking coal, 3.3 of pet coke, 1.1 of fertilizers, and 1.1 of forest products. So all these products that you see which USA exported to China, they can all be bought from at least 4 or 5 different countries around the world. So if the tariff war really had stood its ground, China would have imported this from other countries. Now they may import partly from America and partly from other countries. So obviously a tariff war can only hurt the US economy and certainly not China. And that's the main reason why over the last week or so, the Americans and Chinese have come to an agreement of reducing from both sides 115% of the tariff rates that they had imposed on each other. Now, if you look at last year, and this is from Bloomberg, if you look at last year's import value from China to America, it was $429 million worth of goods. Of that, if we apply the various dependency factors that Bloomberg has put up for us, you would see that almost $200 billion is something that America cannot do without. Or 46.4% of all exports which were currently going to America will continue to go. Now, with the tariffs being reduced to just 30% of the balanced cargoes, we think that part of it will be absorbed by the Chinese currency having weakened against America. Partly will be absorbed by the shippers reducing their prices, and partly will be absorbed by the receivers paying the difference. So I think that all the amount of goods that were exported from China to America via containers last year, I think that that value and volume will remain roughly the same. This shows you the usual chart that we put up for dry bulk trade and shows you what's happening for 2025 and expected for forecast for 2025 and forecast for 2026. Similarly, for minor bulks, here you can see the forecast for 2025 and 2026. Again, just to show you that Clarksons keeps getting these numbers wrong. And even if you look at just trade growth for 2024, even in Jan 2025, they were revising the numbers that they gave in December 24 for the year 2024. And again in March, they revised the numbers further. So you can see that even past tense, they still seem to make mistakes. Similarly, this is what the trade growth shows for 2025 as a forecast and what is the fleet growth for their forecast. If you look at the percentage of time that each category of dry bulk ships spends on different cargoes, you can see Capesizes are mainly carrying iron ore 75% of the time, 16% of the time on coal, and 9% in carrying bauxite from Guinea in Africa to China. If you look at the Supras and Handys, you can see that Supras spend 54% of their time carrying minor bulk cargoes, and Handys spend 55% of their time carrying minor bulk cargoes. So these are more important cargoes to us than the major bulk cargo, which is iron ore, coal, and grains. I just want to show you this slide to compare what is the amount of specific cargoes that we carry compared to the rest of the world fleet. So if you look at steels as an example, we are carrying about 3.5 times more than the world average, and they're on our fleet of ships. And this is mainly because the ships that we own and operate are built in China. They're very strong ships and carry a lot of steel. So this is just one example which I wanted to show you and to highlight that the ships that we have from China are excellent ships. This slide gives you what is the current status of the world fleet as of the 1st of April 2025. So totally there were 14,431 ships in the world, between 10,000 and 90,000 plus deadweight tons. Average age was 12.78. Total deadweight was 1,039 million deadweight tons, and the average deadweight per ship was 72,000 tons. If you look at the last column on the right-hand side, you can see how many deadweight tons was added in the first quarter, and it looks like just under 10 million deadweight tons was added in the first quarter. If you look at this slide, it shows you that the total order book as of 1st of April, based on the existing fleet at that time, was 10.26%. And if you look at this slide, you can see that the total 20-year-old fleet as of the 1st of April was 10.18%. So more or less in line with the order book. Therefore, it looks like replacement tonnage. Now, this chart also shows you that the extreme point of 78% was reached in 2009. And after that, you can see how the forward order book as a ratio of the existing fleet has kept dropping till it became lower than the 20-year-old fleet, which you can see, which is the red line. This slide gives you the position of all these numbers based on the 3 or 4 periods of time that we have selected for you. One is the big bull run in between 2003 and 2009. Then the very bad market for 11 years between 2010 and 2020. Then the 2 good years again in 2021 and 2022, followed by the not so good years, but still profitable years in 2023 and 2024, and where we are in the first quarter of 2025. Now, this slide shows you that every single category of ships has fallen in speed over time, because it's not just that the markets were good or bad. Of course, bad markets make ships slow down, but more than that, it's also now the new regulations which are coming in the terms of decarbonization. They're forcing ships to slow down. And you can see that whether it's Capesize, Panamax, Supramax, or Handy, every single fleet has come down in speed. This is a congestion slide, and it tells you how many average days do ships in the different sectors spend in port, and it's given to you over the years. Now, it's the same thing for Panamax and Capesize. So this is one way where the fleet is reduced by having to stay in port for a long time. So if you look at, say, for example, the Supramax sector, you can see that it peaked at 190 days in 2021. And that is why 2021 was a good year. 2022 was at 186, which is the second highest total. And that was also a good year. And then after that, you can see that the congestion levels start to drop. If you look at the BDI for the first quarter of 2025 compared to 2024, 2023, and 2022, you can see that the BDI was down by 39% compared to 2024, 11% higher than 2023, and 45% below 2022. But when it comes to new orders placed in quarter 1, you can see that it is the poorest quarter so far amongst the 4 years that we are comparing. And if you see that in percentage terms, it was below the 2024 figure by almost 90%. It was below the 2023 figure by 85%, and was below the 2020 figure by 87%. So mainly the reasons for that are shown in the 4 items that have been put down for you. And the other factor, of course, is that Q1 was impacted by Trump, his tariffs, his trade war, all of which led to people losing confidence and not ordering any ships, which is good news for the future. So under the industry takeaways, what would you see? You would see that the IMF, which was forecast a GDP growth of 3.2% in 2024. The OECD initially projected global GDP growth of 3.3% for both 2025 and 2026. But these forecasts have now been slashed to 3.1% and 3% respectively due to policy uncertainty and trade barriers raised by Trump. So tariffs and trade barriers which have been created by Trump. China did meet the expected GDP growth of 5% in 2024, and China's economy grew by 5.4% in quarter 1 2025, despite the tariff and trade barriers put up by Trump. Ton-mile demand growth is forecasted at 0.26% in 2025, with significant uncertainty around dry bulk trade. Now, I'm sure when Clarksons reforecast this number in a couple of months, we will give you an update. You will see that the forecast will have grown significantly because now there is no fear of either America going into recession or the rest of the world going into recession, because they've already started to bring down the tariff barriers in a significant way. Steel consumption in China in Q1 has been marginally positive. Of course, when compared to 2024, when it was marginally negative. Increases is supported by shipyards, EV car makers, infrastructure, and steel exports. So these are the four major positive points. In terms of fixed asset investment, it was 3% in 2023, 3.2% in 2024, and is expected, and in Q1 year over year is up by 4.2%. So consumer spending has also rebounded weekly. So it seems that the Chinese government is trying their best to keep the economy going well. The dry bulk fleet grew by 3% in 2024 and is expected to remain unchanged at 3% growth in 2025. But net effective supply will tighten due to lower speeds and in compliance with EEXI and CII regulations. If you look at the forward order book to fleet ratio at 10.26% as of 1st April 2025, it is marginally higher than the existing 20-year-old fleet at 10.18%. Then there are further disruptions. The Red Sea is still continuing to be disrupted despite Trump stating that he has got a deal with the Houthi, but the Houthis are still continuing to lash out at any ships that are controlled by Israel or any oil cargoes that move in and out from the Red Sea. If you look at the fleet growth, it's roughly going to remain unchanged in 2025 compared to 2024, but net effective supply, as I said, will decrease because of EEXI. Supply demand balance continues to improve, and therefore we think that markets will bounce around a lot. There'll be a lot of volatility thanks to Trump and his changes, but it looks like things are getting better now. So what is our strategy then? Our strategy has been twofold: to reduce the fleet average age and to reduce the greenhouse gas emissions per ship. Now, this slide shows you a comparison between the Handysize index ship, which is 38,000 tons, and our Handysize ships, which are 32,000 tons. So basically, you can straight away see that we need at least a 20% discount on our ships just on size. And if you include oil consumption, then we need a further discount. But anyway, let's just take it like this and see that the market average for the Handysize fleet was $9,053. If you apply a 20% discount, it comes down to $7,242. Against that, we had an average earnings of our dry bulk fleet at $5,255. So we were below our adjusted index at 27.4%. If you look at the Handymax fleet, compared to the index, it was at a minus 3.3%. So almost equivalent to the index ship. If you look at the Supramax index and the Ultramax index, if you differentiate these two, you see that the Supramax index average was at 8321 for the Supras. And if you discount that by the 10% factor that we think it deserves, you would see that the index level would come to 7489 versus that our average for the Supra ships was 8067. So we were at a 7.7% plus rate when you compare to the adjusted index. If you look at the Ultras, we were at a minus 2.8% compared to the index. If you look at the forward 4-year book, the total contract value is now standing at 164 million or 163.5 million deadweight tons. If you look at the bar chart underneath, it shows you the number of days of time charters that have already been fixed. And you can see that will now, as time goes by, will start to pick up, where you see that for 2025 it's at 34% and 2026 at 17%. You'll find that both of these will start to pick up as we keep adding more ships onto longer term contracts. The ships that are on longer term contracts in 2027, 2028 and 2029 are mainly the cement ships. If you look at our fleet renewal, we sold the 4 ships. If you look at these 3 ships, Ratna, Charana and Rojarek, and compare them with the 4 ships that we bought here, or 5 ships that we bought over here, you can see that we bought 40,000 ton size ships compared to what we sold was 28,000, 33,000 and 29,000. If you compare the Vikanda Nari at 53,000, we sold her and we replaced her with a 63,000 ton. So 10,000 ton more deadweight, but in terms of speed consumption, better than the Vikanda, which was 12 on 26, and this is 12 on 21. Similarly, if you look at the other ships, they were 12 knots on 18 tons, 17 tons, and 20 tons. Against that, the newer ships that we bought are 12 on 13 tons, 16 tons, 16 tons, 17 tons, and 16 tons. Now, Gautam will take you through the financials.
Thank you, Khalid. So just the highlights for Q1. In Q1, we reported a net loss of 140 million baht, or $4.14 US million, or about a loss of 9 satang per share. Our EBITDA was positive, however, so it was 282 million baht, or 8.33 million US. We declared a final dividend for the year 2024 of 10 satang, which we paid on 2nd May. So in terms of investing, so we entered into a joint venture agreement with 2 Malaysian companies called Lian Sun and M Straits through our Singapore subsidiary. We hold 45% in this joint venture company. It's called Nusantara Maritime. And this company will focus on owning ships in the tanker and gas sectors, which will help diversify, stabilize, and grow the company's revenue base. Now, I should add that we've just incorporated this company, so it's going to be a while before this company is up and running. I expect revenue contribution from this company only perhaps 9 to 12 months from today. We will, of course, give you regular updates on the progress of this joint venture company. In addition to that, we formed 2 new subsidiaries in Malaysia. So one in Labuan and also another one in onshore in Malaysia to take advantage of some opportunities that we are seeing over there. In terms of financing, so during the quarter, we signed a US 30 million credit facility agreement with Krung Thai Bank. So in terms of acquisitions of vessels, so Khalid already mentioned, we bought the Umanari Ultramax. We took delivery of her on 8th of April, and then we also disposed of the Rojarek Nari on 19th of February. This is Rojarek Nari is a 2005 built vessel, so one of our oldest ships. In terms of charter coverage, so we had 5 ships on the long-term time charter contracts at fixed rates, and we had 12 ships that were on long-term time charter contracts with rates linked to the underlying index for vessels of that size. So here's a picture of the acquisitions and the disposals of ships. Khalid has already covered this, but just one thing to mention. So we have 4 Ultramaxes under construction at Sanfu shipyard in China, which are scheduled for delivery starting from the beginning of next year. So every 3 months, an Ultramax, new building Ultramax will be delivered from the beginning of next year. So key figures, financial figures in Q1, as I said, so revenue in Q1 was 31.8 million compared to 44.2 million in Q4. And this was primarily because the freight rates in January and February were extremely depressed for a number of reasons. So one of the reasons is because there was an extended holiday period in China. China, as Khalid mentioned, is the biggest demand driver for dry bulk. So there was an extended holiday period in China. In addition to that, there were also some weather-related events which led to lower trade of commodities. That was a temporary factor, and so the markets reversed in March. The markets recovered quite strongly in March, and they continue to be quite strong until today. Anyway, so the lower revenues, the lower freight rates in January and February resulted in our incurring a loss for the quarter, a loss of 4.1 million, compared to a profit of 7.3 million in Q4. On a per share basis, that's 9 satang loss. The number of ships at the end of the quarter was 39, but of course it went up to 40 after we took delivery of the Umanari. So here's our, okay, at the top left, you can see the average time charter rate per ship per day over the last 5 quarters, and you'll see that Q1 was particularly bad, although as I said, this was mainly because freight rates were low in January and February. March has the rates normalized as a result of the low freight rates. EBITDA also took a hit, and so okay, this did not really affect our dividends, however. So we continue to pay our dividends as we have normally done over the last several years now, and our cash balance, of course, also remains quite healthy. So this is a picture of our balance sheet. So you'll see that our shareholders' equity position is quite strong. It's 488 million, slightly down from 496 million at the end of last year. Our total loans and debentures is down slightly to 240 million compared to 249 million at the end of last year. And vessels and equipment has remained more or less the same. So this is a picture of our cash movement in Q1. So you'll see we started the quarter with 64 million of cash on balance sheet. We generated 6 million of cash from operations, lower than normal because of the lower freight rates. We had 12 million of capex, mainly for the down payments for the ships, the ship that you acquired, and also for some payments towards the new buildings. And then we received 9 million from the sale of the Roderek. Finance costs of 4 million, which have remained fairly stable. We had loan repayments of 10 million. And yeah, cash at the end of the quarter was 49 million. So over here, okay, so I've already talked about, so this is our long-term loans from banks at the end of the quarter. It stood at 200 million. But I think this is important. So these are our undrawn loan facilities. So you'll see we've got 157 million of undrawn loan facilities available. So this is really firepower for growth. We see opportunities over the next 12-24 months. You can expect that we will draw down on these facilities to acquire assets. This over here is shows you the breakdown of our operating expenses on a granular basis. So in Q1, really there was not much change in terms of our operating expenses. That said, this year we have a record number of ships that will be undergoing dry dock, and so the DDSS, this figure over here, will creep up through this year. Our operating expenses continue to be lower than the average industry OPEX. So every $100 saved over here translates to $1 million on the bottom line at the end of the year. So as I said, so 24 ships will undergo dry dock this year. Many of them underwent dry dock in Q2, and many will undergo dry dock in Q4 as well. But again, look at next year. Next year, there's just 8 ships. So we'll have a much more normalized, in fact, below normalized level of ships that will be undergoing dry dock next year. So over here, we show you the OPEX and G&A for our Supramax, Ultramax fleet. These are Q4 figures, and we compare this to OPEX and G&A expenses for our listed peers. There are not many listed peers that we have in the Supramax, Ultramax space, but here's the data. As you can see, that we are our OPEX and G&A levels are below our our industry peers. And over here, we show you our EBITDA per ship. So taking into account the revenue as well that we get from the ships, and you'll see the EBITDA per ship. We are the second highest compared to our peers, both for Q4 as well as for the last 12-month figures. Here, this is debt maturity profile. So you'll see that we don't have any major maturities coming up. It's fairly flat. 2028, 2029, we have some debt coming due, primarily the debt principal payment. But of course, you will see that we will be refinancing this most likely in advance. Over here, we show you our net debt and net debt to equity ratio. So extremely healthy. Our net debt to equity ratio is just 0.4. And yeah. Over here, we show you, okay, so the top line over here, it shows you the average age of ships in our fleet. So you'll see that from the year 2005 until about 2011, we had a fairly elderly fleet, whereafter we took delivery of a number of ships from new building vessels from shipyards, and the average age of our fleet came down to 5.8. And since then, it's of course been going up, but over the last few years, we've been making an effort to sell some of our older ships and acquire younger tonnage to arrest this increase in the average age. Now, with an increase in the average age of ships, it negatively impacts the marketability of ships in the fleet, particularly in a weak market. So in order to have a stronger fleet for the future, we really need to get a more modern fleet, and which is what we are constantly making an effort at doing. Over here, this line over here shows you the average TC rate per ship per day. You'll see that from 2016 was actually the bottom of the market. And since then, the market's been moving up on the back of healthier demand-supply fundamentals. This line over here shows you the average operating expenses, which have been moving pretty much in line with inflation. So we've been paying, our policy is to pay not less than 25% of net profit as dividend, and we've generally been paying more than 25% of net profit as dividend. We stopped paying dividends from 2014 until 2021 as we wanted to conserve cash. That was a period when freight rates were extremely low. Freight rates have since recovered, and so therefore we have resumed paying our dividends. Right? The latest quarter as well, we've also paid dividend. As you know, we have announced a share repurchase program, and as of 23rd April, we've acquired about $7.31 million worth of shares, so a fairly substantial number of shares, average repurchase price 5.89. We report our repurchases to the exchange every day, so you're welcome to see our reports to the exchange on a daily basis. We report it at the end of each day. So this is a lot of data, financial highlights. I won't go over this. This is a reference slide, and yeah, so I think let's go to the Q&A. I think we've got several questions, and let's leave the other slides as reference slides.
Okay, so the first question is, what are the major reasons for the 32% year-on-year decline of time charter income during first quarter 2025? Was there any change in customer behavior in response to the tariff war? Yes, obviously there was a change in the behavior of the customers. They did bring down the level of activity because people were worried about the trade barriers, about the tariff wars, etc. So importers were reluctant to import raw materials and were trying to push out the exports on container ships so that they could cover up as much cargo out of their inventories before the tariffs hit. The second question is, what was the company's strategy during first quarter 2025 that impressively lowered the admin expenses by 13%?
So it's really a variable compensation, which we did not provision for in the first quarter, and that contributed to the lower admin expense in the first quarter.
The next question is, what will be the strategy to increase earnings per share and profitability in 2025? Well, the answer is quite simple. A lot depends on what Trump is doing. And right now, he's heading in the right direction. We expect that in the next 90 days, you will find many more people trying to ship whatever bulk cargoes they need to ship before the pause of reduction in tariffs, reduction in the absolute value of the tariff rates stays alive. And hopefully by the end of the 90 days, either we will get a further reduction on these tariff rates, or at least they will be made permanent. The next question is, does the growth of the Chinese shipbuilding industry impact positively or negatively to the PSL's income? Of course, if there are many, many more ships created than are needed, it's a problem. But as I showed you, in Q1, we did not order many ships because of the trade imbalances, the tariffs, the trade wars, the tariff wars which were taking place. People just sat on their hands and did not order any more new ships. If you look at the next question, can you just go back one? Yeah. Although a higher steel consumption drives higher imports, the fleet growth may accelerate. Yes, so we think that the fleet growth will not accelerate too much. As I've said, we've shown you the data to show that maximum 3% increase in net supply will take place in 2025 as compared to the same amount of increase which was there in 2024. And these will be reduced further by the slowing down of ships. If you look at the next question, does the growth of the Chinese shipbuilding industry impact positively or negatively? Okay, we've done that. What are the most popular reasons for customers choosing the handy-sized ships instead of Supermax or Ultramax? Besides the shipment weight factor, does it relate to factors such as port congestion, conditions, long travel distances, fuel consumption, or ship availability? I think it's a combination of all the factors that you mentioned. If you look at the next question, where were most of the PSL's customers in 2024 from China? Do you expect the same? No, our customer base is not really from China. Our ships do trade a lot into China, but they trade with international customers that we have. So we have no real angle or expertise to be able to talk directly to the Chinese consumers. And we don't know them that well. We don't know the language, and we prefer to deal with counterparties whom we've been dealing with for the last 30, 40 years. And therefore, that helps us a lot in getting good business from our clients who then talk to the Chinese directly. Coming to the next question, at the current level of BDI, second quarter 25 will continue to be tough, similar to what happened in first quarter 25 for the company's earnings. No, it's not correct. Gautam already told you in his presentation that since March onwards, rates has gone up quite sharply as compared to what was there in the first quarter. So we don't think that the quarters can be comparable. It looks like more like a normal year where Q1 is low, Q2 is higher than Q1, Q3 will roughly be, if it follows traditional pattern, will be roughly similar to Q2, and then Q4 will be the peak. Then the last question which is there, will we see a front loading ahead of the peak season for the dry bulk industry during the recent 90-day tariff pause? Yes, we think people will try to take advantage of the tariff pause. I think that's covered by questions.
But I think having said that, I think dry bulk commodities, they're fairly low value commodities. So with even a 10% tariff actually is quite hurtful to the trade. So I think already, like for instance, the Chinese, they've when there was already talk about the tariffs, they already switched from buying grains. They used to buy a lot of soybean and wheat and corn from the US. They increased their purchases of soybean from Argentina and Brazil rather than the US. This is something we've seen now for a few quarters. I think the first question as well is what customer behavior have we seen change over the last quarter? That is one, customer behavior. And we'd seen this during Trump 1 as well. The Chinese bought a lot more grains from South America. And so the US grain producers, their market shrunk because China was the biggest market. So what they did actually is they've sold a lot of their commodities to South America. So South America, instead of using their own produced grain for their domestic consumption. They actually imported a lot of that from the US. So that added to ton-mile demand because you had this new trade that was created from North America to South America and then South America to China. And South America to China is 10% longer on a ton-mile basis than the US to China. So that's positive. Maybe the other thing I could mention, since we talk about USTR, USTR made people hesitant to trade Chinese ships into US ports, but that hesitation has gone away because there's no disadvantage for Chinese-built ships as long as the owner is not Chinese.
And as long as the size is below 80,000 deadweight tons.
Right.
ค่ะก็หมดคำถามพร้อมกับเวลาก็หมดลงพอดีด้วยต้องขอบคุณทุกท่านที่ร่วมส่งคำถามเข้ามานะคะค่ะเวลาของPSL ก็หมดลงเท่านี้พบกันใหม่ไตรมาสหน้าค่ะขอบคุณค่ะสวัสดีค่ะ
สวัสดีครับ